The old adage was, don't ever be married to a position. Don't ever be married to a target of where you think it's going to go. My year-end target in gold is 6,000. I put that target out at the end of last year. I don't have any reason to change it, but it got close at 5,600. Now, inevitably, I think that it will run and test 100. I don't think the days of 100 are over. We've hit that benchmark. The 121, not so realistic. By virtue of that theory, it will go above 5,450. So I'm exceedingly bullish once we have some sort of confirmation that this correction, because I do not believe we have pivoted from bull to bear market sentiment. So silver is under both moving averages. It needs to take out $80. That's the key level. Once it does that, then I look at these tops, 83, and then I look here at 87. What we do know is it's been really, really good for gold, because the more uncertain you are about actions and upcoming events, the more it will affect gold taking it to the upside. So regardless of your sentiment on his policies,
gold has seen a massive move. Of course, we're consolidating right now if you look at the charts, but is this the beginning of a breakout or a shakeout? And of course, I'll talk silver with my guest. His name is Gary Wagner. He's the founder and brains behind the Gold Forecast. Really looking forward to having him on the program. He's one of the best technical analysts that I know out there, and I can't wait to hear his opinion on where we're at in this cycle. Is this the end already? Should we get used to perhaps lower prices, or are we trending higher? But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously reach our goal of 100,000 subscribers before the end of this quarter. Let's see if we can make this happen together. Really appreciate the support. Now, Gary, it is great to welcome you back. Exciting times we live in. It's good to see you.
Absolutely a great time to visit. Gold is on fire. Silver, to a lot of degrees, is also. But we're witnessing history here. Having gold right now, and I'm referencing all of my talk will reference the April futures contract. So for those who are going, well, gold is slightly under 5,000. When you hear me talk about it over 5, that's the differential. And March silver for silver, but $5,000 silver. And that's after it hit $5,600 per ounce intraday. My God, when you consider how far it's moved, how fast it's moved, it is incredible, and we've got some charts to back those statements. This isn't just smoke and mirrors, people. This is gold on fire. This is silver on fire. This is an asset class that those that believe in said, we're really going, my convictions have panned out. Those that didn't expect it are just going, wow. Gold and silver are something that everyone should look at. I believe should have in their portfolio. Start it with physical, however you want to do it. But to avoid that component in your total investment portfolio, I think you're cutting yourself short in terms of what you could be doing.
Fantastic. Gary, we'll work on backfilling those statements. That was a great opening. I think one of the better openings we've had on this channel here in a while. But before we dive into the technicals, because you brought us some charts as well, just based on your estimate, like where in the gold cycle are we right now? How early or how late is it?
I think that after, and this is only based upon the fundamentals I'm looking at, as well as technicals Elliott wave, which I won't bring up today, but I think that recent high I hit was the first of yet another top that exceeds that before we go into any extended correction. Right now we are in a correction, so we'll focus on where I think it could find support, how much lower it could go if it does go lower. And traders, we have to remember at any point in time, anything can happen and we can get this way wrong. I know that when it was moving up and I would do these interviews, one thing I made absolutely clear was that at any moment, at any time, for any reason or no reason, they're going to slam this market because it was ripe for picking. The big professionals, the large institutional players had banked huge profits on this run. And it's just simply when they want to book those profits. And that will happen again. So even though we'll remain bullish long-term overall, state that we are in a correction moving lower before we head to this next rally. I say that with the caveat that anything can change on a moment's notice, whether it's a fundamental piece of news that institutes or implements that change, or traders and technicians going, at this level, this is what we want to do?
This opening framing from Gary is critical for understanding everything that follows. He is not a permabull blindly calling for higher prices. He is a trained technician who saw the correction coming and told his subscribers it was mere profit-taking the moment it started. The distinction between correction in a bull market and reversal to a bear market is the single most important question any precious metals investor should be asking right now. Gary's answer is unambiguous. We are not in a bear market. The fundamentals that drove gold to $5,600 did not change on January 29th. What changed is that professional traders with enormous paper profits decided to book them. That is normal, that is healthy, and that is temporary.
No, fantastic. Yeah, good assessment there. And I like the positive tone, of course, Gary. But let's take a look at the trend structure together. I'm curious, like, is it still intact? Like the move higher, of course, or has it broken over the last, 10, maybe 10, 14 trading days here?
Sure.
We have seen the corrections. I'm curious, of course, is it still intact, Gary?
Okay. All right.
Let's bring that up.
So what we're looking at is a Japanese candlestick chart. For those that are unfamiliar with the chart, these green candles, think of a bar chart, are simply drawing the rectangle around the open and closing price, just like you'll see hash marks to the left representing the open in a bar and right. If it's in green, it simply means that it opened at this point and closed at this point. So it opened higher. It's a way that I believe you get more information than you do in a bar chart visually. You don't give anything up. It uses the open, low, high, and close. Red is the opposite, means it opened near the highs or near the top of the range and closed much lower, as you can see in this one $500 drop down day, small decline for a day. So the question of where are we? I've got this going back to December 31st, just so we can get an idea of what has gold done this year. Well, at the beginning, it moved from 4,300 to an intraday high. That's what these little lines here represent. On a red candle, the close is down here, the open is up here. But on the red candle, it represents the differential between the open of the day and the high of the day. And I'm using that to plot really how high gold has moved. Let me try to get that. There we go. And so gold, from the beginning of the year to its absolute high, gained almost $1,300 in just not that much time. This is January 29th. So literally 29 days, it gains $1,200. Unsustainable, obviously. That's when it gets just ripe, and you're going to get people that have banked tremendous profits. Anyone that got in anywhere from here, and we're talking trading, not physical accumulation, because they've been buying all through last year. They saw it here. When it came down, why would you sell it? You're not looking to buy it and sell it quickly, and they're still holding on to it. And I think they're in great shape because we have gold over 5,000 again. Spot is, I believe, slightly under that. But that's an incredible move when you consider that at the beginning of the year, you could have bought it at 4,300, and now it's a lot higher, $700 higher, even after coming down really, really hard. These were harsh days. This shook the market up, and that was what it was intended to do, because the market got frothy. It got to a point where professional traders had huge profits, and they're thinking, this isn't going to last forever. And it didn't have to take too many of the big boys to start liquidating. When you liquidate a futures position, you buy it to go long, and liquidating means you sell it. And so they sold it here. It could have been short plays, which is easily, you can't really tell from the chart. But what you do know is profit taking. And that's what when I saw this big drop, what I reported to our subscribers who view our daily show was that this is mere profit taking. Nothing fundamentally on a large scale has changed. Everything we were looking at, what was this, the 29th, everything that occurred on January 29th, fundamentally, that took gold to these unreal highs, was still in play 3 days later. But gold 3 days later was at 46. It dropped $1,000.
The $1,200 rise in 29 days, followed by a $1,000 drop in 3 days, sounds catastrophic when you see it in the headlines. But Gary's chart puts it in its proper context immediately. The drop only gave back the gains of the final parabolic surge, not the entire bull market. Gold is still up $700 from January 1st, even after the crash. The Elliott wave ABC structure is one of the most reliable correction patterns in technical analysis, and Gary is applying it surgically here. The key insight: if the C wave completes around $4,600, $4,700, that is the buy signal, not a sell signal. The market would then be positioned to launch the next impulse wave that targets above $5,450 and potentially $6,000.
So it hit that low. You can see it's kind of at a midpoint between this high, the start of the year, and this low that came in during the fall, February 2nd. So right at mid-range. I believe at this point that we're in, and this is just technical trading. Of course, market goes straight up and challenge these, and I believe it will. But I think if the techniques I follow have any kind of truth to it, we had kind of an A wave down, a B wave up. We're in that C wave, and the C wave, even as a flat, should take us back to 4,600. The good news is, according to this theory, this is what that will put us either into the next cycle. If we look at this as a fifth wave, for those unfamiliar with Elliott wave, it looks at periods of price movement up, and that's a series of 5 waves. Think of it like stair steps or a ladder with every other thing. Markets don't move straight up. We call that parabolic, but typically they go from $1 to $2, and then they tend to move back to 175 or 150. In other words, they gain so much and they give anywhere between a third and a half back, just roughly. And then they move to a new high, and then they give a little bit back. And then they move to a third high and give a little bit back. But typically, when you hit those tops, you go into what we call a correction, which is, it can unfold many ways, but the most common is a simple ABC, which would be hits this high, we get our A, we get our B, we get our final C. Now, let's say it went up here. There's terms that the Elliott wave technicians going to, now it's a truncated ABC. So they've got something that they say if it doesn't fit the pattern. If it moves just to here, it's called a flat. And a typical ABC will actually make a lower low. But I look at a system, a technical study like this as something as it's a roadmap, but not necessarily giving you all of these little side roads, because fundamentals move the market, technicals plot the market. It shows you where you've been, not where you're going. There's only a couple of what I call forward technical studies. Most of them look in the rearview mirror and go, okay, that's where the waves are if you're on a ship, let's say. It doesn't tell you where the ship's pointed. And my old saying was, only the captain knows when he's going to turn the wheel. Well, it's a couple of people, but in other words, you don't know when that major shift happens until it happens. And those are all guided by by fundamental things like the Fed decision that's coming up. What is the CPI going to report? What's going on politically? All of those components make up the fabric as to what is going to move all asset classes higher or lower. In the case of gold, it's global, not like the US stock market or stock market in Germany. So it is really sensitive not only to US Federal Reserve action, but to a war in Gaza or to Ukraine, Russia, or to any of these conflicts, because gold's barometer to make it move higher or lower is what I'll call the uncertainty factor. The crazier it is out there, the more uncertain you are about what tomorrow, next week, next month is going to bring, the more sensitive gold reacts to it and moves in accordance.
Absolutely. We've seen those moves, of course, in the past. So If that's a guide, then we know we're in for some turbulence here. Absolutely. And I know, Gary, you brought us a chart with some momentum indicators as well. So I'm curious, is the bull market still intact? Obviously, based on what you're saying, I think we're all positive here that we're still fine. But I'm just curious, like, are we overbought, oversold? Like, what territory are we in right now? And given the fact that it's Chinese
Absolutely.
New Year week as well, what do we make
Well,
of it as well? Should we? How much do we interpret into it?
the interesting thing about the Lunar New Year that just started in China is the reports I have read say that gold is a big factor in that holiday. Not so much this year. That's what the reports are saying. Why that's happening is your guess is as good as mine. Maybe because Asia as a whole has been a huge component of moving gold higher. They've been very aggressive buyers. The government's been large players in terms of feeding their central bank and taking dollars and moving them into gold, doing that strategic transfer, which is not an unwise move, and they're not the only ones doing it. I think the whole idea of fiat currency is whatever's needed maybe to do what they're going to do, but that's not where you probably want your assets long term. And most governments have been in an accumulation stage of purchasing gold and adding it to their balance sheets of their central bank. So that's not unusual. But back to the question, are we overbought or oversold? Well, obviously, just a short look, we're kind of in the middle ground. We just put up the 50%. These lines here are just called the Fibonacci retracement. What they do is I go from this high here down to this low here, and I calibrate all the levels in between. There's 23, 38. Actually, I could put up to 38 because that's kind of where gold is right now. This is the 38.2. And we'll even put this up. These are the main. It just gets a little busy, which is why I don't have them all on. Let me just do one other thing here very, very quickly. And that's move everything, these labels to the right so they kind of get out of the way. There we go. So as you can see, from this high to the low, gold has moved up to about 50%, close to 60, and then settled back down. It's now at a 38% level. So that is a level that could be held easily. And I believe inevitably gold will return to rally mode and challenge at least 5,400, the opening price that occurred before the big sell-off. I look at the range in terms of where the market's been in terms of absolute highs. This high was an intraday high. It was a wick. What that means is when it went there, it didn't hold. It was unsustainable, and it actually fell from 56 back down to 54. So it took back $200. So the real range to me is about 5,400 to about 4,600. And what I'm disregarding is these wicks, these intraday highs and intraday lows, because they weren't sustainable. In other words, if it closes at that point, that means that as the traders brought it down to those lows, there weren't people buying the dip. They were thinking either it's going lower, they were uncertain, but it wasn't a point for them to bid it higher, which means that it wasn't oversold. Overbought is simply as it goes up, there's a point at which it's too high, traders are going to enter and pull profits or initiate shorts. So we're really not at mid-range. 50% would be right around 5,000, and right now we're trading just under that, 49.97. So according to the basic ABC tenet, it should go a little lower. I'm thinking if it does a flat, so call it 4,700, at that point it's completed that sell-off cycle, and it goes into the next what's called an impulse or motive phase, which means you're looking for it to go into rally mode with 5 waves, 1 being up, 2 and 4 being counter waves moving down, but 1, 3, and 5 taking us to higher pricing. And if that's the case, by virtue of that theory, it will go above 5,450. So I'm exceedingly bullish once we have some sort of confirmation that this correction, because I do not believe we have pivoted from bull to bear market sentiment. Absolutely not.
The Fibonacci retracement explanation here is the best accessible introduction to this tool you'll find in any public interview. Gary demystifies what can seem like mystical chart reading into a simple, logical framework. Measure the range, divide it into meaningful proportions, watch those proportions as price moves through them. The 38.2% level where gold is sitting right now is not arbitrary. It's where buyers historically step in because it represents a meaningful but not extreme pullback from the top. But Gary's most profound insight is the self-fulfilling prophecy point. Technical levels don't work because of magic. They work because every trader in the market knows them and acts on them simultaneously. When enough capital moves according to the same technical signal, the signal creates its own reality.
The key indicator to market technicians is this green line here. These are two moving averages, very short. What I could go short term, I used to use when I was younger, 13 minute, 7 minute. This is a 20-day simple moving average and a 50-day simple moving average. According to most market technicians, including myself, the easiest way to black and white technically determine is it a bull or bear market. If it's above the 50-day simple moving average, we're in a bull market. If it's below it, we're in a bear market. Now, to give you an idea, if I compress this chart and I'll move it back in a second, I'm going to have to rescale it. You can see this cross that came in. In other words, when you have a consolidation market, see how close these two lines are? And I'm looking at a period from August 25 back to about May 25. And you notice the green and purple line are right on top. Here's the breakout. And what you want to look at in a breakout is a widening of the moving averages. As they widen, it tells you it's gaining strength. As it narrows, it's telling you it's kind of losing strength. And then here where we went parabolic, depending on how you compress the chart, but this is as close to parabolic as you can get. And that's when it moved to the all-time record highs. You can see this base here. That's why I've got that rectangle there. And that's kind of how I look at it. Then if we zoom back in, you can see these moving averages are pretty much widening. And what's on the bottom is called a relative strength indicator. It's a momentum indicator that determines technically if it's overbought or oversold. When it moves over 70 in this kind of a technical study, it is considered overbought, and that's when we look for possibly to correct or come down. If it goes down to 30, which we have not seen, that means that it's in a sell-off, and that's really time when a market technician is going to look to accumulate. Right now, it's sitting at 55 and 51, and what that means is kind of right in the middle. So it's closer to overbought than oversold, but it's right in the middle. So it tells me that if it does continue lower, we'll see as long as we see this correction, this will go lower. But at the point at where it finds support, it's going to move back kind of like it did here, which is well over the 70 line. So what's my conclusion? My conclusion is we could see gold drift lower, but the way I look at it is rather than a hard fall, it's almost been sideways, which is a way of saying it's building a base, it's consolidating. And again, these technical indicators are a footprint. It's a map, but you can't follow the map. Sometimes they close roads, sometimes construction happens. In other words, they're not written in stone. So we could see at any moment gold take off. And if it does, this is the market's going to challenge 5,400 basis the April futures contract, which is probably about 53.80, 53.70 for spot. The closer it gets to breaking above this 20-day, that's going to be where if it does close back above that and move off of it for 2 days, that's when us market technicians will label that as a breakout. and a stronger potential for rally mode to enter. If it continues to go down, I would want to see how it reacts at the 50, because that's a critical mark. You get a lot of selling pressure if it actually goes through this area. Now, when we look at silver, you see that there are absolutely different parameters going on, but that overall is how I'm viewing the market currently.
This is the most technically dense and valuable segment in the entire interview. Gary is giving away the exact same framework he charges subscribers for at the Gold Forecast. The two moving average bull-bear market definition is elegantly simple. Above 50-day equals bull. Below 50-day equals bear. Gold is still above it. That's the only number that matters for long-term investors who don't want to get lost in the noise. The RSI at 55 is the good news. There's no extreme oversold reading that would suggest panic selling or capitulation. The market is not scared. It's digesting. The 2-day close above the 20-day SMA as the rally confirmation signal is the specific trigger to watch. When Gary says that, he's telling you the exact level and the exact condition that will signal the next leg higher has begun.
Phenomenal explanation there, Gary. Really, really insightful. I think everybody understands now where we're at, and makes a lot of sense. The only last follow-up question on gold I have is really, I see the purple and the green line about to intersect, and perhaps purple cross over the green line like we've seen there on January 8th. Like, how likely is that to happen there, Gary?
I don't know. What do you think? I mean, the key is, rather than saying how likely is it, it's going to be, are we going to sustain a further sell-off, as many technical theories expound will happen in this kind of a correction, with the caveat that anything can happen at any time because of any of these factors. Right now, the anticipation with the Fed is to hold rates steady. The CME's FedWatch tool, which is a probability of rate cuts, rate holds, and rate raises, and that probability is gained by talking to those who are futures traders in interest rates. So these guys are pretty acutely zoned into rates. It's what they do. It's how they make or lose fortunes. So they tend to be fairly accurate, because if they're not, they don't tend to be interest rate futures traders for very long. It's a kind of a job that when you perform, things are good. But if you don't perform, you either got to figure out what you're doing wrong, or you got to, go do something like me, be an analyst or sell car. I don't know. But so right now, as if that happens, that's what's anticipated. If that changes, if we get, and nobody's anticipating either, but if we get a rate cut, which is what people are anticipating, is not now, but maybe in June. But if we get one earlier, which is, I think, a 3% probability right now, that would really move the needle for gold. Gold is not interest bearing. If interest rates go down, it makes this asset class a much more viable opportunity, because it can move when interest rates change. The opposite would have the opposite action. So I think that I believe we're getting close to this correction being over. Once that happens, I believe we will return to rally mode, because in the big picture, nothing has changed. Russia, Ukraine, still fully entangled. We're certainly not best buddies with the Iranians in terms of the negotiations. That could go anywhere. Trump likes to be heavy-handed militarily. So what he did in Venezuela, now he's got warships around Iran. He's not afraid to use the military, and that wraps the uncertainty factor way up. No matter what you think of his administration and his actions, what we do know is he's been really, really good for gold. Because the more uncertain you are about actions and upcoming events, the more it will affect gold, taking it to the upside. So regardless of your sentiment on his policies, and I kind of want to keep those close to my belt, I don't think that that's anyone's concern, is that the more heavy-handed he gets on a military basis, the more the uncertainty factor goes up, and the more gold reacts in a positive manner. So that's a wild card that's not so wild, because we've seen historically that he isn't afraid to use military actions to kind of hone or form the kind of world he thinks that it should be.
Gary introduces the uncertainty factor as gold's primary price driver, and it's the most practically useful framework in this entire interview. Gold doesn't just respond to inflation or dollar weakness. It responds to uncertainty in all its forms: geopolitical, economic, monetary. And the current environment is extraordinary on every dimension simultaneously. The Fed is paralyzed between inflation concerns and recession fears. Trump is deploying warships around Iran while fighting tariff battles with allies. Russia-Ukraine shows no signs of resolution. Each of these creates a floor under gold's price, independent of the others. Gary's point about Trump being really for gold is not a political statement, it's a technical observation. Uncertainty equals gold buying. The Trump era is the highest sustained uncertainty environment since the Cold War.
Absolutely. Just wait for the SCOTUS decision on the tariffs as well. So that'll cause mayhem, in my opinion. But before we run out of time, Gary, I quickly want to talk silver, of course, as well, because we've seen absolute mayhem in the charts. And maybe you can help us make some sense of what is happening in the silver price. Of course, very different animal. The question is, do you see similarities, or is silver a different beast altogether?
Absolutely a different beast that tends to run in the savannah as well as gold. They're both running in the same financial plane, but they're reacting different. Silver is much more volatile. First of all, you have less participants. So in terms of volume, it's a thinner market, less liquidity, so it takes less to move more. Secondly, it is extremely volatile because there's a lot of speculative action. Unlike in gold, there is speculative action, but you've got so many institutional players and the central banks working gold that it's harder to move the needle one way or the other. I mean, when you think of the kind of move we've had, let me just do this real quick. Put up a date and price rate. Now, I guess I got to do it December to December. Although it's just been a phenomenal move. But if I do that, so we'll go to, right here. So from this point to the all-time record high, silver moved up 71%. And if we go back to this chart from the same time period, end of December to their highest point, it moved up 29%. So immediately you see a major difference in terms of the percentage gains when they're rallying, really 2-to-1, almost double the performance of gold. Now, a candle that burns at both ends does burn twice as bright. Boy, it lasts half as long, because when it fell much harder than gold did, just in terms of it went from $120 to $63. In other words, although if you look back to gold in the middle of 2011, it hits 1900, it would trade down to 1,000. So it halved, but it took 5 years, right? If you remember that, from 2012 to 2015, it went from 1900, which was the high then. It's when I was convinced it was going to 2000, but forgive me, I was a lot greener than I am now. Not that I couldn't still make that mistake. But when you consider that when we were looking at the highs, same time period, January 29th, to the lows, which is really recently, February 5th, we're talking a week or so ago, it gave back half of its value. Now, inevitably, I think that it will run and test 100. I don't think the days of 100 are over. We've hit that benchmark. The 121, not so realistic, sustainably. Not that it won't wick to that point. But when you look at this retracement, I believe it's a longer term. Yeah, this fib retracement, let's change this so everything's equal from what we looked at in gold and what we looked at in silver. I just need to go apples to apples, oranges to oranges. So it makes more sense. Let's go ahead and blow this up. So when you look at the highs to the lows, 50%, again, 20-day moving average, 50-day moving average. So think about where gold was in terms of the 50-day moving average. That's down here. But it is very close to 20-day. If we go back to silver, this 20-day, look at how it not wicked up, but how it spiked up and then came back down. Look how close they are now and how wide they were. See, as the rally went, they widened. But this sell off was so brutal that it went from this level down to this level with that sell off. So you got a lot more volatility. But it does appear as though we're in the same point of the correction if the idea of an ABC correction has any weight. Again, it's a technical study. And I've always believed that these technical studies are self-fulfilling prophecies. In other words, in the old days, we all looked at stochastics. If it's overbought or oversold, if it went to 80 and crossed, all the traders went in and sold. If it went to 20 and crossed up, we all bought. Self-fulfilling prophecy. In the same way, when we look at what's going on here, it's when it breaks through these points, it tends to really ramp up the speed, intensify the speed at which it's going through its cycle. So silver is under both moving averages. It needs to take out $80. That's the key level. Once it does that, then I look at these tops, 83, and then I look here at 87. Once, and I should say if and when, because we don't know that, if and when it breaks above 87, on a technical basis, there is no resistance because of this large drop here. And then you can look at these candles behind it, but then it's a race back up to, this is 115. What I think is really realistic is 100. That would be my earmark for when it goes back into rally mode and it begins to accumulate value rather than the value gets diminished. Have we completed the correction? It looks more plausible in silver, but I don't believe that technically it's done. But again, the caveat, because it's not going to be the technicals that move it. It's going to be the fundamental events and the sentiment of the traders. And they're a very, very interesting bunch in that they only have two parameters. And there's a million things that control how they weigh and decide what parameter to focus on. Do I think it's going higher or do I think it's going lower? Because I need to make money. I can make money both ways. And so what is my sentiment? What do I think? And that's what really moves this market, futures market. And that sentiment is based on all those other things we talked about. Fed policy, geopolitical conflict, all of those things that they look at to determine whether or not they think it has a higher probability of moving higher or lower. Silver is just volatile. If it does continue to drop, at absolute worst be 63. I don't think it's going to go there. I think that if it does continue to fall, I'd look at $70. And right now it's trading what, at 77. Again, traders, this is March silver futures. It's going to be different than spot. Take away a couple of dollars, but look at these relative levels and the distance between these areas I'm showing, and then kind of compare that to your spot chart.
The silver analysis is where this interview gets truly exciting for investors who understand leverage. Silver's 71% move versus gold's 29% over the same period is the clearest possible demonstration of why silver belongs in a precious metals portfolio alongside gold. The same structural forces that drove gold drove silver twice as hard, and the same correction logic applies. The fundamentals didn't change when silver crashed from $120 to $63. What changed is that leveraged speculators got margin called out of thin market positions. Gary's roadmap is specific and actionable. $80 is the key breakout level, $87 is the resistance-free zone, $100 is the realistic rally target. For investors sitting on the sidelines, this is a technical framework that tells you exactly what to watch and when to act.